Hello and good morning. This is Sunil, Jhaveri, your host and host, also known as MisterBond in the mutual fund industry, welcoming you back on One-on-One with Mr. Bond in conversations with Aditya, the star fund manager of large and mid-cap fund of Motilal Oswal. Welcome, Aditya.
Thank you so much, Sunil, for having me here.
Not at all. A pleasure. We had taken an interview of Niket Shah earlier. We are going to talk about large and mid-cap fund today. Some of the funds which have done exceedingly well in the Motilal Oswal basket. But Aditya, what I'm going to do is I'm going to ask you not only on your scheme, but we are going to talk about some global macro factors also. I'll ask you whether post-SEBI recategorization, which is the true Flexicap according to you, and then we'll take on and move on to your large and mid-cap fund also. So let's begin. The first and foremost, Aditya, there have been 2 or 3 instances of recessions in the past. One was in 2008, one was in 2020 March, but those were short-lived recessions because of various Fed interventions, etc. But the current situation is totally different, where the inflation has gone through the roof. Interest rates have gone through the roof because Fed had to hike interest rates. Do you think that the recession which is likely to set in or has already set in is going to be more prolonged this time because Fed will not have much room or leeway, to print more dollars or cut interest rates in a rising inflation scenario?
Sure, Sunil. I mean, the question you've asked me is purely an economist question.
Absolutely.
So I'll be honest here. I mean, look, we've seen last 15, 20 years, whenever a US got into a recession, they have the leeway of either lowering the interest rates as well as using their financial muscle in terms of printing as much money.
Absolutely.
So even though we might speak so much that US balance sheet has expanded, Fed balance sheet has expanded from $2.5-3 trillion to $8-9 trillion, but still, I mean, why can't it go to $10-11 trillion?
Oh, okay.
So, I mean, my feel is that, in case things get murkier, times to come, probably they will use their balance sheet to good use by printing more money and bringing the economy back into good shape. Okay. But as of now, I mean, again, we have to look at where was the US economy 6 months back. I mean, 6-8 months back, the inflation was clocking 8-9%, which was like a precarious situation.
Correct.
But now due to some interest rate increase by the US Fed, inflation has come down to sub 5%.
Right.
So right now, things are not as bad as what they were 6 months back. Plus, I mean, economic data, if you track in US, the employment data, the retail sales data, even though they have worsened, but still they are holding well from that point of an overall basis.
Okay.
One would have expected that things would have worsened much more with the interest rate increase it has been. So absolutely. I would say that economy is not in that bad a situation as one would have thought to be.
So what I hear you say, Aditya, is that the world is talking about the recession across the globe, but you are saying that the situation is not as bad as what it seems currently because of the lot of intervention from Fed already.
Yeah, and also Sunil, recession is a very, I would say, very loosely used word. I mean, 2 quarters of GDP degrowth might mean recession, but it might mean minus 1% GDP decline. So that is, I mean, that is bound to happen. We will see a recession.
Correct.
But it will, my view is that it might not be as bad as what one expects from that point of view. Also, if we see at earning growth, US market is expecting for S&P. I think this quarter they're expecting a growth. This quarter they're expecting a decline of 6-7%. But December quarter, the expectation is that earning growth will bounce back to 1-2% in December quarter and probably 7-8% in March quarter.
Wow. Okay.
So, I mean, the sum total of economists' wisdom in the US is indicating that probably we have crossed the bad phase and now we are in a consolidation phase which might take place for a couple of quarters and then things might come back, bounce back from that.
Correct.
From that low base.
Absolutely. Now let's look at the Indian markets.
Sure.
If you see this data from October 2021 to the current data, naturally the markets have corrected from the valuations which were extremely expensive. So if you see, the price to earning was at 28, currently we are at 21 in the NIFTY 50. Midcap also has come off from say 34 to almost 23 now, and small cap is 29 to 18.8. And naturally, the major carnage has happened in the mid cap and the small cap space.
Yeah.
So valuation perspective also, and if you notice, the earnings have also grown at the same time. So both the combination of better earnings growth in the Indian context and the already corrected markets has given a good opportunity in the Indian space. So is that where you are seeing more value happening? That's the reason why emerging markets like India is having more and more inflows from these FPIs and the foreign institutional investors.
Look, Sunil, again on a valuation front, if we strictly go by the headlines, valuation is neither cheap nor it is expensive.
Correct.
If we go by Nifty, the most commonly
it is
talked
better than
about
October
index,
2021 where there was some excesses happening.
Yeah, it is better, but we have to understand like now also Nifty is trading at around 21x 1 year forward. Last 10-year averages has been around 1920. So we are broadly where it has been an average last 10 years. But we should not forget that, I mean, last 2-3 years, we've started a new structural, I mean, economic cycle from that point of view. Like corporate profit to GDP, which was languishing at 2.5-3%, now it's 4.5%. So, which means the reinvestment capability of Indian corporate is much better than what it was 2 years, 3 years back.
Right.
So, this is again leading to some buoyancy on the capex side. This is leading to, I mean, again, employment generation. Even though headline has not been very great, but the top 20-30 crore people, I mean, employment generation has been good, mainly due to IT sector has been doing relatively fine. So, I mean, multiple wise market doesn't look very cheap, but what I would say that structurally we've entered a good phase as far as Indian macro is concerned.
Correct.
I mean, macro, if you look at macro, I mean, globally, macro looks to be much more challenged. Like, I mean, last 1 year, it's all been about monetary tightening. We've seen inflation, as we spoke, in US 8% has come down to 5%, but it's still way off the mark. The comfort,
because the comfort is at 2%,
2.5%. So which means the US Fed has to do much more to tame it down to 2%. But we were always a 4-5-6% inflation economy in India.
Right.
Now inflation is sub 5%, the CPI inflation. Even though RBI has a range, 4% is the upper band of its range, so we are very closer to its range. So the RBI doesn't need to do much further on to tame inflation,
which was
reflected in the recent
monetary
MPC
policy also, where they said they did not do any tinkering on the rate side, neither increase nor reduce.
So which means probably we are at the end of the rate increase cycle,
Absolutely.
which is also in the US, but maybe their rate drop will take longer. I mean, rate will remain higher.
Now some of the economists are talking about maybe they'll skip in June, but maybe they'll raise rates in July again, depending on the inflation numbers, etc.
But we have to understand rates are closer to the top. Whether it happens 1 time, 2 time, it's all academic from that point of view.
But still, the interest rates are at a higher levels, and that's going to have a lag effect on the corporate earnings, which generally happens in the interest rate cycle. So, in the Indian context also, what I hear you say is that we are not cheap. We are at a reasonable valuations, better than October 2021. So my question to you is, if Nifty 50 is at reasonable valuations, not cheap valuations, and if that corrects based on the global macro factors, you think the large cap, small caps and the mid caps also will be spared, or because of the valuations which they are attractive at, they continue to have a rally? So something similar happened in 2015-16, if you remember, when large caps corrected for the first time, but the mid cap and a small cap had a rally.
Look, Sunil, as a rule, I mean, mid or small and mid cap valuation correction doesn't decouple from large cap. So as a rule, whenever large cap correct, mid and small cap also
so that's
correct.
What I want the viewers to hear that.
Yeah. So I mean, both moving in different direction could be an exception.
Which happened in 2015.
Yeah, it might, out of 20 times it may happen 1 time, 2 times, 3 times, but that is not the rule per se. So in case large cap correct, obviously mid cap and small cap will also correct. But what we have to see is that, I mean, economy right now is doing much better than it was been doing last 5 years, 7 years. So it's a much more broad-based economic growth what is happening. When that happens, you see the mid and small cap does not correct as much as a large cap.
Right.
I mean, so because a lot of mid cap, small cap will also, I mean, I think they will not correct as much as what corrections has been in the
Even
past.
if they correct, I think that will be a great opportunity for Indian investors. Am I right?
Yeah. I mean,
It's a no-brainer.
whenever Indian markets have corrected, in hindsight, we've always said that what an opportunity it was. So, I mean, it goes without saying
Correct.
that market needs to be bought in bad times.
Yes.
That is when, I mean, you make
But the unfortunate part is the investors do just the reverse. They buy high and sell low.
I would not say that. We generally generalize, how SIP flows have moved last 5-6 years,
Correct.
3-4 years. Indian retail investor, I think, has come of age.
Yes.
Even when FI investors have been selling, markets have been weak, you've seen very good inflows happening to the mutual fund side. Also, why India is doing well is also, we should not forget, money chases return. Whichever economy, whichever market does well, money comes to that market.
So India will have its own premium.
India will have its own premium, and we should not forget China. China is a big economy which has attracted a lot of flows in the past.
Correct.
The Chinese market is same where it was 5 years back.
Oh,
so
yes.
5 years, zero return. Incrementally, investor will think, let me take out some money from China and put into a market like India.
But do you think India can have its own time correction also, like what happened in China?
Look, 5 years is a reasonably large time correction from that point of view.
Correct.
That is not the view as far as India goes.
Because
you have to see the entire GDP construct. Our real GDP is growing by 6-7%, inflation 4-5%.
So 12-13%
nominal GDP is
GDP.
growing by 11-12%, corporate growth being there, and we all know that India, in terms of belief of foreign investors in India, as far as a much bigger, much efficient democracy. Correct. And all. So, and policies have been much more investor friendly in India as compared to China. So, I don't think so that we will go through that correction. Also, you have to remember that just like any company, any economy goes through its life cycle. So China, the working age, that group is not growing. Population is not growing.
Our demographics are much better.
Our demographic today, median age for India is 28-29 years.
Wow.
I think it's China, if I'm not mistaken, it's 37-38 years, 36-37 years. So you're not seeing working age population increase in China. But India, we're having hordes of people who are getting into the working age population.
Absolutely.
So demographic plays a part as far as valuation goes.
Correct.
From that point of view. So I don't think so India will go China
way. So the viewers should be rest assured that India's growth story is there. It may not be decoupled totally. For some time, if there is pain in the global markets, we will also see the pain. But those are opportunities for Indian investors.
Yeah, sure.
Correct?
Yeah.
Now let's come to your large and mid cap. Now, first and foremost, viewers must understand the SEBI categorization of what large and mid cap means. The definition of large and mid cap is that minimum 35% in large cap, which is the top 100 companies in terms of market capitalization, and minimum 35% in the mid cap space, that is the 101st and the 250th company in terms of market capitalization, is what the fund manager has to invest in. The balance is at the discretion of the fund manager whether he wants to increase large, mid or small cap space. Now, Aditya, what I want to ask you is, there's the SEBI recategorization which happened. There is an overlap of Flexicap, multi-cap, large and mid cap. Now, which according to you is a true Flexicap? Because the Flexicap says that 65% can be in large, mid and small cap. That is the SEBI definition. Multi-cap says 25% minimum in large cap, 25% minimum in mid cap, and 25% minimum in small caps. And large and mid cap says minimum 35% large cap, minimum 35% in mid cap, and rest is at your discretion as a fund manager.
Yeah.
My data shows that if you see this data, generally in the last 1 year average of Flexicap, most of the fund managers and most of the Flexicaps are large cap oriented. Almost 65% is in large cap, 17% in mid cap, and small cap is 10%. In large and mid cap, you are approximately 51% in large cap. This is the industry average. Sure. 37% in mid cap, and about 7.5 or 8% in small cap. And in the multi cap, 41% in large cap, 25% or 26% in mid cap, and 26% in small cap. So Flexicap is more large cap oriented. Multi-cap is where you have to perforce invest in small cap. It has done well because small caps have done well since its recategorization. But going forward, if the drawdowns are accentuated, the small caps also, correct immensely. So is large and mid cap the true Flexicap according to you? So if you see this data from till 2019 when Flexicap did well, this is again the industry average. That was the reason where large caps were doing well and mid caps and small caps were bleeding. But if you see currently, the large and mid cap has outperformed Flexicap by a big margin if you see the 2020 data and 2021 data.
Sure. So Sunil, like, because you've chose these three categories for deciding which is a true two-label multi-cap, so firstly I would eliminate Flexicap from that point of view. You have to understand, like 3-4 years back, Flexicap, as the name suggested, was a go-to category for multi-cap.
Absolutely.
But I mean, because schemes had become bigger by size, there was a constraint in terms of buying mid-cap and small cap. So by default, most of these larger Flexicap move to being a 65% plus large cap in a way. So I would say Flexicap, I mean, as the name says, is not a true reflection of the category what it exists today.
Correct.
So which means the choice remains between large and mid cap and multi-cap. Again, multi-cap is a newly created category wherein 25% each in large, mid and small cap. So I think multi-cap is a good category to be in, because one, it has 25% each in each of the market capitalization. So on a longer term basis, it is a good true to label multi-cap in my view. But large and mid cap, as the name says, has only large and mid cap. 35% large, 35% mid. The balance 30% is on the discretion of the fund manager. So no one stops the fund manager over there from taking 30% exposure to small cap. So in a way, it is closer to a multi-cap category from that point of view, but it has one additional advantage as compared to a multi-cap category. Like we all know that small cap has its own risk.
Absolutely.
I mean, when drawdowns are there, drawdown in a small cap space is much higher than a
very accentuated.
Yeah,
absolutely. What you are seeing currently,
we already saw that. So I mean, because a large and mid cap category doesn't force me to be in 25% into small cap, I think drawdowns in bad phase will be lesser than a category like multi-cap from that point of view. And the fund manager has all large, mid, small, all hunting ground is in front of him. I mean, it is upon him whether you want to have 25%, 30% small cap also in that category.
Absolutely.
So I think from a flexibility point of view, this category serves better.
Unfortunately, the investors and the MFD community has not really caught on to this side of the story, where the large and mid cap is the true Flexicap. Let me tell the viewers that 1 crore invested in 2018 January. I'm giving you the figures. In March 2020, that 1 crore in large cap Nifty 50 was 72 lakh rupees. In Nifty mid cap 100 was 52 lakh rupees, and Nifty small cap was 36 lakh rupees.
Okay.
So the drawdowns in small caps can be very, very accentuated, and that's where the volatility will creep in. So according to you also, I think we have a similar view that the large and mid cap is the true Flexicap, where at the discretion of the fund manager, they may wish to increase in small caps or invest in small caps, but in the multi-cap space, they will have to perforce invest 25%.
Sure.
Am I right in saying that?
Correct, Sunil.
Yeah.
And also, I think what we saw in Flexicap, as and when schemes become much bigger, I mean, they are handicapped to invest in small cap.
Correct.
But what happens in case a scheme becomes bigger in multi-cap category? They will be forced to put 25% into small cap in a big scheme.
Absolutely.
So which might not work to advantage for in times of volatility and all those things. So I think large and mid cap gives you that flexibility.
I agree. I totally agree. I think we are going to do a session for the mutual fund distributors for them to understand the large and mid cap category, and the title of that is going to be which is true Flexicap.
Sure.
Okay, now coming to your own fund, large and mid cap, the current portfolio mix, this is as on 31st of May. And tell me the reasons why you have increased your allocation to a small cap versus the index average. So you are underweight in large cap, 45% versus 53% in Nifty LM 250. Underweight in mid cap, 35% versus 46% in Nifty large and mid cap 250 index. and overweight in small cap 20% versus 1% in Nifty large and mid cap 250. So the reason behind this is our earlier slide where the small caps had corrected immensely and the valuation is there. Is that the reason why 20% in small cap?
Sunil, look, that could be one of the reasons, but broadly, my investing style is more bottoms up from that point of view. So I don't take a call that next 1 year I'll want to increase into small cap in a big way.
Okay.
It is just depending on what stocks come in. In case it's a small cap, well be it. I mean, It doesn't matter to me. So I would say that it is a coincidence that a small cap exposure increase in this fund has happened at a time when small cap valuation has corrected.
Okay.
Because look, small cap what we own in the portfolio are not the very small caps. Because look, small cap definition is very wide.
They are on the verge of tilting towards mid cap.
Like small cap definition is from a market cap of 0 to 19,000 crore.
Wow.
So lot of stocks.
That's huge.
That's huge. So my style is I don't want to put a lot of money into companies which are sub 5,000 crore market cap.
Right.
Not the micro caps from that point of view. That's why you'll see that out of the 20% allocation into small caps, only 2% allocation is into company which is less than 5,000 crore market cap.
Okay.
So majority of the investment into small cap is companies which are 15,000, 17,000 crore market cap.
They may be called small caps, but in reality, they may be in that mid-cap space very soon.
Yeah, they will fall into mid-cap, maybe some after 6 months, some after 1 year.
Right.
So objective is to capitalize on those small caps and buy maybe at 5,000, 7,000, 8,000 crore market cap. They become into mid-cap very fast. I don't want to, because look, you have to understand the lower down the market cap curve you go, mortalities increases at that point.
Absolutely.
So I don't want to, because this is a large and mid-cap category.
So what I hear you say is that you are investing more into small caps which are likely to be future mid-caps.
Which are larger small caps.
Yeah, correct. And the mid-caps are the future large caps. That's the way I think I would put it. So that's where you are going to be more focused on small caps which are likely to be mid-caps in future.
Yes, that's why. And like if you look at the small cap, what we have in the fund, that 20%. Again, by coincidence, you will see 50% of that falls into a sector like healthcare.
Okay, I'll come to that.
Okay.
Now this is the small cap allocation skewed towards healthcare. So my next question, which you have prompted right now, is 12% consumption, 7% chemicals, 55% in healthcare ecosystem. What does that mean? Also, we will understand. And manufacturing and capex is 25%. So you were saying why healthcare?
Look, again, one thing is to see the return what a fund can give. But a lot of focus of mine goes into controlling the risk of the fund.
Okay.
So the moment you take a 20% exposure of small cap into category large and mid cap, whatever said and done, it makes the fund slightly more riskier. But then how do you control the risk? How do you bring down the risk or balance the fund? By having a large allocation of that small cap into a defensive sector like healthcare.
Okay.
We all know that healthcare is not
it's all season kind of.
It's a defensive sector. So that's why large allocation of small cap has gone into a defensive sector like healthcare, because in bad times when economy does badly also, you will not see these stocks do badly. Because
just to interject, some of the diagnostic labs, etc., which became very popular during COVID time, have all gone under post-COVID. So I'm sure you're not in that segment. You are beyond that segment.
Yeah. So it's mainly into hospitals. It's into health insurance. It's into pharma companies.
So health insurance also forms part of this healthcare ecosystem.
In this, I don't know whether you've included. So like 10% will be hospital in a fund.
Okay.
4-5% will be pharma company, and 2-3% will be pharma retailer from that point of view.
Okay.
So we are playing the total domestic healthcare chain, right? From a company which makes medicine for the Indian market only, hospitals, and then a pharma retailer.
Wow.
We are not playing exporter over here.
Okay.
Because Indian market looks a much more promising branded generic market. It's a proxy to consumption market on an overall basis. So so investing over here in this fund is a combination of more top down as well as bottoms up. So top down, you decide that because India is a very consumption like pharma market, you buy different players in the value chain in the Indian healthcare space.
But that story will continue forever. The way I hear you say that the healthcare system is a defensive space, and that story will continue in the Indian context. So you mean to say that you will be overweight in this healthcare system forever, or there will be some change in your stance?
Sure, look, forever is something
I know,
we
it's
don't say, because what if the valuation
but I'm saying
becomes
that sector is supposedly a defensive sector forever. So would you be overweight in that?
Look, one of the thing last couple of years, I've been underweight in IT.
Okay.
I've been 5-6% point underweight in IT. So mentally, how do you balance the risk of the fund? Underweight in IT is a defensive sector. So I've used that opportunity of being underweight in IT by being overweight in pharma, so that it makes the portfolio much more balanced and controls the risk of the fund. So at some point in time, suppose I go overweight in IT, maybe I might cut down some weight on IT weight. I mean, 5% weightage.
Will you take a contrarian call now in the IT going forward?
I mean, if you look at midcap IT, it is no longer a contrarian call. I mean, all midcap IT stocks are trading at 52-week high. Wow. And valuations are like...
So they are also already...
Yeah, they are. So I would say that large cap IT is where I think they have not participated at all, and value earnings are moving up. So they are going through a couple of quarters of weak phase, but I think large cap IT looks to be a good place from a contra investor point of view.
So if at all you will get out of healthcare, you would look at...
I might. Healthcare might not be the only funding round. For example, IT used to be 2% weightage a couple of months back. Now it is 5% weightage. So we've already increased weightage in the thing. It has not gone through healthcare funding. So it is a combination of valuation, what different companies have. It's a combination of outlook. So a lot of things go into...
Sure.
I mean, but incrementally, IT exposure would increase for me next couple of quarters.
Perfect. Now let's talk about the sector allocation. So your consumption 25%, lenders 24%, others 5%, healthcare system, ecosystem is 20%, manufacturing capex 1%, IT 5%, and chemicals 3%. Sure. So any commentary on this sector allocation?
Look, Sunil, again, one of the objective is to make the portfolio return much more stable. Right. Like in past, we've seen that taking a big call on sector leads to sometime portfolio performance doing very good, sometime portfolio performance not being subpar. So objective is to make the portfolio much more balanced from that point of view. That's why you see today the portfolio is much more balanced. Like lenders being 24-25%. In case you have to play the India macro story, I think banking remains the best way to play.
So is it the PSU or the private sector?
No, it's all PSU. Only one large PSU lender will be there, but broadly it's the top 6 private lenders in India.
Okay.
So I mean, because still banking as a space, I mean, they have done well last 12 months, but I think that space still has value. I mean, considering the improvement we have seen in the asset quality and the P&L and balance sheet of bank, still I think valuation is much more comfortable over there. So lender remains 1/4 of the fund. Consumption, look, India is following the US way in terms of consumption, and consumption is a very loosely used term.
Correct.
I mean, what used to be consumption 10 years back, HUL, today consumption spans from...
It's all aspirational consumption also.
Yeah, so I mean, and India is an economy at 2,300 per capita income. In 5-7 years time, when it becomes $4,500 per capita, I think a lot of consumption categories will do very well. So this is a sector which offers you that steady 15%, even though it could be volatile. Like a lot of discretionary stock, you saw that March quarter results were not very great.
Correct.
And you saw top line being under pressure due to the inflation prevalent in the economy.
But that's a passing phase.
Yeah, that is a passing phase. If you take a long-term view, I think a lot of these companies, categories offer you that steady consumption growth over a longer term. So I think consumption, whatever said and done, valuation is not cheap in this space, but they offer you that longevity of earning growth. And apart from that, manufacturing is one space where I think I should be more. I mean, incrementally, whenever you meet companies, I mean, India, so that is...
So the China plus one story is panning out?
I mean, it's China plus one, you call it, China minus one, you call it. I mean, over the weekend, I was visiting a electronic manufacturer plant. I mean, 3 hours of interaction, kind of, I mean, they were so bullish. They have not seen this over the last 10 years. Wow. I mean, the RFQ pipeline.
But tell me, this China plus one theory is being touted, but is it actually happening on the ground? Let me ask you why I'm asking you this question. Is a lot of companies in US also, US is also thinking similarly. The way we are thinking made in India, US is also saying made in USA now. So they want to bring manufacturing back into US. So the other countries are also thinking on similar lines. So is India the only destination where China plus one is going to pan out and we will benefit out of that, or
Look,
everyone is looking inwards?
Yeah, look, one of the repercussion of COVID, one of the repercussion of Russia-Ukraine war
Correct.
has been that everyone is looking inward.
Inward.
I mean, everyone wants to become Atmanirbhar from that point
Absolutely.
of view. So every US is also trying to bring as much manufacturing what can be brought within US. But you have to remember that US has that problem of, I mean, not many people. Supply side is a problem there. People,
and the manpower.
Manpower is a big problem there.
Correct.
And that is one big factor you need in production side. And plus manpower is very expensive there. So you will see US focusing in terms of work which are very high end, which can afford to pay high cost for those manpower. But I mean, mid end, low end will keep on moving to countries like India,
Sure.
Vietnam, Indonesia, and all those countries. So, and plus China, everyone wants to defocus or reduce their dependence on China. So, I mean, when you meet these companies, manufacturing companies, you have to understand that where India is right now. And so I was just telling you that, so the word strategic inflection point.
Correct.
So Mr. Shiv Kumar, the ex-CEO of Pepsi, used that word yesterday in his newsletter. So manufacturing is one of the sectors which have gone through that strategic inflection point during the last 2-3 years when COVID has happened. And when these strategic inflection point happen, it's not for 1 year, 2 years. It's much more structural in nature. So I think I'm a bit less on manufacturing side. So probably even though valuations are not very cheap here, they have done very well as a space, but that offers a long-term opportunity from that point of view. Apart from that, healthcare, I told you that ecosystem 20% is entirely in the Indian domestic chain. I have 2 hospitals here having 10% weight. Then there's a pharma company, domestic pharma company deriving 97% of revenue from Indian market.
Wow.
So that's 4-5%. And then you have a pharmacy retailer, and then you have a health insurance company. Because again, this is a sector which went through that strategic inflection point during COVID. We all knew that health was very important earlier also.
Right.
But I mean, we've become much more conscious about it. And the moment you get much more conscious about it, I mean, so that is one area where spends will continue to be high. And that is non-discretionary expenditure.
Correct.
If someone falls ill, no matter.
You don't have a choice.
But I think the health insurance penetration increasing is giving you that affordability where
everyone has now realized the importance of health insurance.
Look, one is realizing, the other is having money in your pocket.
Correct.
I mean, with health insurance penetration increasing, I mean, everyone wants to get himself or their parents or treated at the beach candies and the Hindujas. And so that is one thing changing, I think. So healthcare remains a very sweet spot in case you're wanting a 15% compounding return in times to come.
Now, finally, your outperformance versus the peers and versus the industry, which has been phenomenal over the last, I think, if you see since inception, 3-year, 2-year data, etc., performance relative to peer group, you have outperformed the peer group by 1.5% over 1 month to almost 1.3% since inception. So it's a great outperformance which you have done. The question in the minds of the investors and the mutual fund distributors will be, can this be sustained? Because what we have been advocating to the MFDs is that past 3 years जो आपने अच्छा return दिया है, you may or may not be able to sustain that in the next 3 years. So what do you have to say to that in terms of the performance, and how will you maintain that momentum which you have created in your own scheme?
Sure, Sunil. So again, Sunil, coming back to basics, I mean, I've been in the market for 17 years. Like, one of my learning has been that disruption will keep on coming.
Correct.
If we see through last 5-6 years, we started from Demon, then a GST happened, then IL&FS crisis happened, then COVID happened, then Russia-Ukraine happened.
Correct.
So you have to construct a portfolio which is much more balanced, because I mean, who knows that there could be a disruption around the corner and we might be talking that India is in a very sweet position and all those things. So
correct.
I think objective for myself is to create a very balanced portfolio. And if you create a balanced portfolio, I think on most time frame it will do. I mean, short term, obviously it's not in your control, but objective is to do well on a longer term basis. So I mean, one of the reasons I showed you that we have equal exposure to large, mid and small cap. Objective is to make the portfolio much more balanced, so that irrespective of when mid cap do well or small cap do well, the portfolio having an exposure is equally benefits from that. I showed you that, I mean, the exposure to different sectors is much more balanced, having lenders 25, consumption 25. So it's a much more balanced construction of portfolio over there. One other thing I didn't highlight to you is that, like, last 1.5 to 2 years, we've seen value investing as a style do well.
Correct. Which prior to that, it was not working.
Prior to that, it was all growth investing.
Correct.
Okay. But how do you do in case a fund is completely value oriented? I mean, times when growth does well, you will not do well.
What is your style? So
my style is, again, objective is to give stable performance to the investors and to make the performance much more stable. Because my view is that, I mean, an investor who gets in on day zero will not remain till the end of the. It's like a city bus. I mean, someone gets up at Borivali, will get down at Andheri. Someone gets up at Andheri, will get down at Bandra. No one will be from Borivali to Churchgate. So objective is to make the portfolio balanced. So I mean, I closely monitor what is the different styles which is prevalent in the portfolio. So I mean, broadly there are 3 styles on a big picture basis: value style of investing, GARP style of investing, and growth at any price style of investing. So I mean, broadly the mix is 1/3 into each in the portfolio. So value will be around 30% in the portfolio, GARP will be around 35%, growth will be 35%. So I mean, objective is to make it more balanced, so that irrespective of which style does well, I mean, the portfolio performance will be stable. So these are some of the things I'm trying from that point of view. I mean, obviously the intention is to keep up the good work and continue doing well.
We hope you continue to do well, because you know, you have really given investors a lot of reason to cheer and smile, because all those who have invested in large and mid cap and even in your mid cap schemes have done exceedingly well. So I hope that this momentum continues. You continue the good work which you've done so far, and hopefully the investors will understand the importance of large and mid cap space, which has been actually, it's a very underrated
because that's a new category. That category came into being 3-4 years back.
Correct, so. But everybody was talking about multi-cap, everybody was talking about flexi-cap, but very few have actually spoken about large and mid-cap. And I'm actually seeing that large and mid-cap versus the flexi-cap, large and mid-cap is a clear winner as of now. Hopefully it will continue to do well also going forward, because of the construct which the fund manager has the ability to do. Thank you so much, Aditya, for joining us on this show. And we congratulate you on a commendable performance, and all the best for continued success.
Thank you so much, Sunil, for all the good wishes.
Thank you. Mutual fund investments are subject to market risks. Read all scheme related documents carefully.